Indiacharts publishes Nifty daily video updates, the weekly Elliott Wave outlook, and the long-short report covering all asset classes.
Last night's big sell-off is coming on the back of oil prices. So what I'm really trying to do here is look at it on a single indicator, that is the RSI. And across commodities, what is really happening, because there are some clear divergences in pattern, because oil has been the late boy to start selling off within the commodity pack, and the other metals have been falling in advance. So what we are really seeing here is potentially what oil ended up doing is completing its fifth wave with an ending diagonal at this point of time. So this is one of the alternates that we are really considering, which means that this is the end of wave 5. And if that is true, then we've just started the first, second, and now third wave down, in which we are probably doing minor 1, minor 2, and so you've got a lot more to go on the downside. So this doesn't look like it's over. The RSI is at around 36, so not yet oversold. Oversold would be sub 30, so we'll go somewhere down here before it's done. So oil prices will continue 1, 2, 3, 4, 5 before it completes 3, then pauses for a fourth wave. So we're probably going to remain sub 100 for a while, maybe even head towards $80. So this is what I'm really sensing in the next move down. But while this is happening, if I simply move to the commodity index, okay, so I'm going to take the Bloomberg commodity index. What I thought there was, initially we had a 5-wave decline, 1, 2, 3, 4, 5. I thought we'll probably bounce just like oil did wave 1 and 2. I thought we'll get a slightly deeper retracement, but instead we only extended down another 3 waves. So now it's gone from being 5 to 9. It can also go 9 to 13. So the commodity index really showing an extended decline, and this might be happening again because oil has got a higher weight and so has energy than metals itself. Because when I look at metals, so I'm going to now go to copper in specific. When I look at copper, the RSI is down to 16 actually, 15.99. So that's 16, which is extremely oversold. So if I take a historical perspective, I think the last time it was at this kind of level on the RSI, we were in 2020. That is one point here where it bottomed. Okay, and the other time was probably here when it had this large elongated sell-off into the bottom of 15, sorry. So 2015 here and 2020 here, two previous points where you reach this kind of an extreme on the RSI, and we are there again. So when I actually look at that, what I end up thinking is, what's going to happen here? It cannot just keep going one way down. So there's got to be a pause. And when I go to the daily chart, what I see is again an extended move, but that should be somewhere coming to a close. 1, 2, 3, 4, 5, 6, 7, 8, 9. So again, could have been 5 waves here. It's got an extension, which means this is 1, 2. This whole fall is 3 till here. Either this way, or there could be a different way of really, marking the third, because I've not really checked if the third is short here. But when you get number of, extended legs, so what you're looking at is this may either complete the fifth in this, or is it going to still, add many more waves. Now, if it's going to add a couple of waves, there will be a bounce that will get the RSI out of oversold, then you develop a positive divergence. All of that is possible. But when you get this low on the RSI, usually I would think you're very close to the point where, you complete a 5-wave decline. This could even be 3, 4 this way, and then 5 could be 1, 2, 3, 4, 5. So then you won't have the problem of the third being the shortest. The point is, 9 legs is equal to 5 waves with an extension, an extended third or an extended fifth. One of which would actually fit this structure, and which is why I would think that copper prices are very, very oversold with a 16 RSI. I wouldn't be bearish on it here. I would actually expect that it gives you some kind of bounce back, and that sort of fits with the sentiment as well. Because when I look at the daily sentiment index, we end up getting extreme points. For example, yesterday's sell-off in the euro, which drove the dollar up, is now down to 8. I'll just explain what that means. And copper is down to 8. Wheat is down to 5. The British pound is down to 8. So these are basically survey readings from tradefutures.com, which essentially explain what traders are extremely bullish or bearish. And this is a daily reading that they put out, and then you actually look at it. So if you get a reading of 8, it means 92% of traders are bearish on the euro. Similarly, 92% of traders are bearish on the copper. And when you've reached that kind of a sentimental extreme where everybody is negative on something, and then I match that with, where we are, say, for example, on the relative strength index, then it's sort of signaling this is the end point. We are pretty close to it. You're seeing a free fall in copper since it was around $4.6. Now it's 3.38. So that's substantial decline. We're still not back to maybe the 61% retracement. So we may be getting there. So let's just measure that for a moment. So this is the entire retracement scale. 61% is somewhere down here. So that's at around this level, 3.2, and we are still at 3.38. Will you continue to slide to 3.2 before you pause? That's again a separate question, because is that the end point? I mean, is it just going to be 61% and go up, or is it going to go further down? If it's got to go further down, it can pause anywhere. Even right now with the oversold reading, I think is a good enough place for it to really pause this decline, consolidate a bit, bounce around a bit before it really goes down again. But what this doesn't match, and so this is the whole point, it doesn't match with oil. Okay, and the oil sentiment also, while low, may not be at the super extreme. Crude light at around 60. Sorry, that's probably not the right one to look at. But yeah, it is. That is true. It's 65%. It's really not extreme. So oil has a far more substantial way to go down than I would think copper. Even though usually commodities move together, but this time because of the geopolitical angle and all to oil, we're actually seeing that massive divergence between these segments. And so I wouldn't be surprised if you end up with a short-term rally in copper while a continued sell-off in oil, and that would really be interesting and might actually end up supporting markets in general, because then they would see that as a narrative where oil, which is a substantial part of the problem, not just on inflation but also European currency deficits and various problems, easing a bit, and on the other hand, copper, which has already fallen, sort of bouncing back, reducing the pain on the economic side of the expectation. And so that could actually be net slightly sentimentally bullish, though weakening of oil prices eventually then gets blamed on growth, which is sort of what the narrative is in the news today. So that's the mixed scenario. Oil, which is not oversold, can still fall. Copper, which looks extremely oversold, I would think at some point rebounds. And that causes a mixed movement in markets, because if we just look at overnight movements and say the Dow and the Nasdaq, that's sort of what we saw. We actually saw the Dow close down. It was much lower during the day because of the commodity oil energy sell-off. And on the other hand, you had a tech index which is actually positive and closed much higher. And that divergence is essentially on the back of these divergences between commodities and other sectors. And so you're continuing to see a bounce. I would think tech, which has gotten very, very oversold also, and has a couple of positive divergences here, as you see on the RSI indicator at the bottom, would end up resulting in a kind of bounce back that is a little larger. So far we've seen so much, but I'll not rule out that this actually moves a little higher, maybe does a meaningful retracement of the last leg before we actually head lower. So 50 to 60% retracement on the sell-off in the Nasdaq from the high that we made back here. Probably that's April, March. So from the top in March all the way down to the bottom in June, 50-60% retracement should be a fair expectation given the positive divergences in momentum and the extremes in sentiment that we're really seeing. And this ends up supporting a rally in various other markets, including Asia. And so Asia has been really off the mark, falling irrespective of what the rest of the world was doing. But in India, at least, we have had this substantial decline from the top of April. And so if I look at the Nifty decline from April all the way to here, most people are not even expecting it to go beyond 16,000. So yesterday's sell-off would have made them feel that this is it. We've almost come to this trend line and we're going to fall. But I sense, given all the other data points I've discussed, plus extremes in sentiment in the Indian market, where people are just willing to sell every rise, and I'm not saying that as my gut feel, it's based on the readings that we actually have in short positions by FIs, the number of puts being traded relative to calls, the put call ratio. Some of these readings are the highest that we are really seeing since the pandemic, which means that's how negative people have become as extreme as when they were at 7,500, even though markets haven't crashed in the same way. And that creates room for a retracement from this entire rise. So I would think that a retracement of the entire fall from April happens, which then actually creates the potential for a breakout past this first trend line and towards maybe the next swing high, which is at 16,800, or maybe a little higher than that, 50 to 60% retracement, and then the next decline happens. This is sort of what I would start building into in terms of the current market behavior. And for reasons that I've already discussed, extremes in sentiment, rebound, falling oil prices, and a very oversold condition in the currency and commodity markets apart from oil. And so that will create a divergence between what oil is doing and what many other sectors are doing, at least in the short term. But be wary of the oil and gas sector. I think that would end up being the worst performing in the near term because of the sell-off in oil. And so that's really the spot to avoid, is the particular sector that is being impacted negatively by that move. Remember that when equities were falling, that was the only sector outperforming when oil was on a high, and now the reverse might actually end up happening when equities are rebounding and the oil and gas sector ends up significantly underperforming the market. So that's my update on the market for today, and till next time, see you.